Welcome back to Polymer Bazaar. We're diving straight into the pet market data for the third week of July 2026. Right now, headline prices in the West suggest a market in retreat. But beneath those numbers, the supply chain in the East is rapidly tightening. This line graph tracks downward pressure in the West. U.S. prices fell to $1,520, while Europe saw a €50 drop. But look at the domestic Indian market, climbing upward against that trend. Local hikes and rising crude oil risks create a very different reality. Relying on falling global spot prices as your only metric is a dangerous strategy. For those buying in the summer market, the headline numbers are misleading. The natural instinct is to wait. When you see global prices dipping, you want to delay your purchase to catch the lowest possible price point. But that delay has to be balanced against the immediate need to secure material before regional hikes take full effect. Navigating this requires weighing the savings of waiting for a lower spot price against the risk of missing your procurement window as domestic feedstock costs rise. We are in the peak summer bottling season. With beverage and water bottle production hitting maximum capacity, standard just-in-time purchasing schedules are no longer reliable. The choice between waiting for a global discount or securing local supply this week will determine your entire Q3 profit margin. The price drops in the West are significant, $65 down in the US and €50 down in Europe. These are the metrics often cited as proof of a buyer's market. However, these specific drops are driven by weak immediate demand. They don't reflect a structural surplus or any reduction in actual production costs. Turkey saw a massive $100 drop to $1,350 per metric ton. This is a prime example of how localized, low buying interest can skew the perceived global average. Meanwhile, China remains in a wait-and-watch pattern, with prices stable at RMB 7,570. This stability suggests a transition point between the falling West and rising East. These localized drops are short-term demand lags. They are masking the rising upstream costs that producers are beginning to pass on. In India, the market is already shifting. Effective July 18th, domestic producers hiked prices by 4 rupees per kilo. Crucially, those same producers have withdrawn the early bird discount scheme. The window for subsidized pricing is closed. On the structural side, Indian customs has held USD-INR exchange rate steady since July 14th, import valuation at 95.20 and export at 93.50, stabilizing the baseline for trade. With overseas CIF India offers for late July already edging up to $1,200 per metric ton, the domestic market is responding to clear upward pressure. When producers pull discounts and raise rates in the face of rising import offers, it is a clear signal that the window for low-cost procurement is ending. Seasonality is now a primary driver. We are in the peak summer window where production for cold drinks and water bottles reaches highest annual volume. This seasonal surge rapidly depletes existing domestic stockpiles, tightening the available supply of PET resin. At the same time, geopolitical crises are pushing crude oil prices higher. This increases the cost of feedstocks, putting immediate pressure on manufacturing margins. This chart shows the result. As feedstock costs rise while ex-works prices remain flat, the margin for producers is shrinking. This forces them to adjust their rates upward. The combination of high seasonal demand and rising oil prices makes further price hikes a mathematical certainty. In a market where prices shift daily, a weekly PDF report leaves your procurement team exposed to sudden fluctuations. To manage this volatility, you need real-time data. The Polymer Bazaar AI WhatsApp bot is designed specifically for these fast-moving conditions. To use it, simply WhatsApp the word PVC to +91 93746 24365. You'll receive instant updates and market predictions in under 5 seconds, allowing you to react to price moves before your competitors do. Using real-time AI tools provides the speed necessary to protect your margins during a supply squeeze. Let's compare strategies. A just-in-time approach attempts to capture short-term savings by waiting for the bottom of the US and EU price drops, but this strategy leaves your supply chain exposed. If a geopolitical event causes a sudden crude oil spike, you are forced to buy at the market's peak. In contrast, the approach of strategic stockpiling involves paying the current 4 rupees per kilo premium to secure your inventory now. This approach guarantees your supply during the highest demand amounts of the year and insulates your budget from the next surge in feedstock costs. A feedstock shortage during your peak production month risks leaving orders unfulfilled. This outcome is far more costly than the expense of holding early inventory. If you are operating in a non-seasonal sector or a region with a significant local surplus, you can afford to wait. But if you are currently in peak season or exposed to oil fluctuations, the data points to one outcome: secure your inventory now. The official Polymer Bazaar recommendation for FMCG and bottling buyers is to buy immediately. Local producers have already moved their rates up, and the early bird incentives are gone. For the full PDF breakdown, visit polymerbazaar.com or contact our consulting team at +91 93754 24365 for a bespoke strategy. Responding to today's local price hikes is truly the only way to safeguard your business against the next global squeeze. Subscribe for our latest updates, and we'll see you in the next report.